Welcome to Money Manager. In the studio with me in Cape Town is Marius Kilian. Marius is the CEO, founder actually, of a company called 2IP, about which I know nothing. So this is going to be one of my favourite interviews because I'm coming off a very low intelligence base. Marius, 2IP.
2IP is abbreviation for Independent Investment Partners. We're a discretionary fund manager. We are licensed under Category 2 with the FSB.
Yeah.
Essentially what we do is we're a professional service provider, and our clients are the advisor base, the advisor community itself,
the IFAs.
family offices, the IFAs,
yeah.
groupings of IFAs predominantly, family offices, and then also some of the large financial service corporates outsource work to ourselves. And the range of services that we do provide is fund manager research and due diligence, which if we look at sort of a lot of the events over the last couple of years have become critical. And if you look at the ONBIT and the rulings that has gone against some of the financial advisors in terms of the quality of the due diligence that they've done, placing money with institutions where
due
institutional
diligence and
risk.
what? What are you talking about when you say due diligence? I mean, if a company wants to buy a company, they do a due diligence on the potential acquisition. But what are you diligently doing for the financial services industry?
Okay, in vetting, it's very important. If you consider any investment opportunity, who's the institution that you're dealing with? What we find is people get so trapped up in the promise of sort of higher returns that they don't understand that they're taking significantly a big risk, which is institutional risk. And we've seen it with a lot of these implosions, is who is the company that you're dealing? Is there risks based on the fact that who they are? If you look at a lot of the fund managers, they're very talented, but if you look at their processes, are there any operational risks embedded in that? And it's very basic questions that you need to ask. Is things like who's pricing their book? The custody, is there separation between the money of the investors and the company themselves and the control that they have over that? So there are various things that we look at purely from an institutional risk perspective, from an operational risk perspective. And then I think the most important part, and that is sort of what we do, is focus on understanding who is this manager, what do they do, and what can we expect of them. Why that is important is there's basically two ways of looking at a fund manager, qualitatively and quantitatively. A lot of people focus on the quants, and you can actually back out any story that you want if you use purely just the numbers. For us, it's critical to understand that what is the performance signature that we can expect of this manager, because there are different styles and biases within managers. And because we know that through market cycles, there isn't one investment style that trumps the others consistently. There is no persistency in that. So it's important for us to understand, if you say to us that you're a value manager, we need to interrogate and understand ourselves qualitatively, get the comfort that that is the case. We will only use the quants to back out whether our view that we formulated of this manager is consistent with the historic numbers. So a big part of that is understanding not only who is the institution, is there any other risks? Because ultimately, what we get paid for is we want to ensure that the client wants to benefit from the risk that he intentionally takes.
I would say to you now that a cynic would say to you now the following: you're just another layer in the investment world, in the financial services cake, because they will say, well, I can go to JSE listed Investec via its Investec Asset Management wing. You can go to Prudential, you can go to Coronation Fund Managers, which is listed on the JSE. You can go to Allen Gray, you can go to Fort, you can go to any Old Mutuals, and whatever it is. You can go to any of these companies, and they've been in business for so long and they're so reputable that you don't need this sort of work from you. But obviously you're saying something different.
It depends on what it is that you're looking for. That's always the starting point. If you have defined objectives, and that is what we are currently seeing, if you look at sort of the changing narrative in the advice world globally, it's always been selling performance. It's been performance-based. Clients are realizing this, and that game it's a loser's game. Trying to chase performance, and that is backed up by the flow of funds. We see that as soon as somebody's got a 5-star or a crown, the funds flow to them. But the question is if you really take a step back and say, well, let's look at what happens to these, the performance of these managers in the following 3 years. And typically they underperform the peer group. From our perspective it's important to start off and say, what is it that you want to achieve? And the world is moving from performance-based to sort of the client narrative, saying, well, what is your personal objectives and what is the amount of risk that you need to take?
So it's becoming more bespoke, in other words. Instead of going to a shop and buying a suit off the pig, you're going to go to the tailor and say, this is what I need because my shape has changed over the last year.
That's the world that we're living in. If you just consider the development of the internet, initially it was just having a placeholder. This is who we are and this is where you can contact us. Then it was this massive flow of information. Then the next step was transactionability. You can buy anything on the internet. The fourth wave is personalization, and we're seeing that happening. That is the modern world that we're living in, is people are demanding personalization. And why it's important is because everybody's objectives are different. This whole sort of trying to be the peer group did not benefit clients. So where we come in is saying is that there are good investment houses, but before you start with what is the framework within which you make the selection, if it's not based on an objective, and that is clients will set long-term objectives and then get caught up in the short-term noise of the market. So our perspective is, let's understand what is your objective, let's model a portfolio optimally to get to that objective.
But you're talking to the IFAs, so the IFAs under their umbrella have lots and lots of clients. So what is your initial engagement with an independent financial advisor?
Our client is the gatekeepers to the clients. We don't deal with the end client itself. So typically it would be IFAs. There are really good IFAs out there that has got the capacity to do their own research and work. But for the most part, they realize in a highly regulated environment. If you consider what happened with the world post-2008, prior to 2008 we had massive deregulation, now we have massive regulation. So the standards that the IFAs are being upheld to and what they need to be able to evidence is very different to the world they lived in 10 years ago.
Yes.
And the IFAs are increasingly sort of turning towards people like ourselves and say, I need to have the depth and the rigor of institutional quality behind me because I'm going to focus on the advice side of the relationship, and the investment management is not something that you can do on the fly. You need to have the capability to optimize a portfolio, to structure a portfolio that is risk appropriate for a client outcome. But that's not all. You need to rebalance that portfolio over time. You need to consider what is the drivers of risk and return in that portfolio. If we look at, for example, diversification, which we throw around like a very sort of simplistic term, the fact that you are exposed to different asset classes and different managers does not necessarily mean that you are diversified. So, for example, if you have a momentum manager who is overweight the retailers and the financials on the equity side, and you have a bond manager that's got a long duration bias, although you think that at an asset class and manager level you are diversified, not necessarily. If on a look-through basis you'll find that there's a macro bet that's going to affect both of them, which is an interest rate sensitive bet.
Talking about diversification, just going off at a brief tangent here, I speak to a chap who, he's a philanthropist. He puts a certain amount of his money into a fund, and if that fund makes money, he distributes that money, the profit anyway, to various charitable institutions. And if he loses, then it's his loss. He doesn't diversify, and he's made between 40 and 50% for the last 3 years. Okay, it's a small amount of money, and it's easier to make 40-50% on 250,000 than it is on 250 million or 2.5 billion. But he doesn't diversify. What he does is he manages his money correctly. In other words, he says, I'm buying something at 100. If it goes to 90, I'm going to stop myself out. That is my stop loss. And a lot of the people, for example, the deep value managers have gone into resources over the last 2 years. They've lost 50%. They don't put a stop loss in. To me, diversification should be tempered with money management, i.e. stops.
If you within that context, it's all about up and downside capture. If you look at for example, some funds would give you 100% of the market's upside and 100% of the market's downside. If you're in a bull market or a secular bull market, that's great. That's like being in a boat and saying, I'm going to throw open the sails. However, if you believe that the following 2 to 3 years is not going to represent the past 2 to 3 years, then probably you want to start rowing. You want to trim the sails. And then it's all about up and downside capture. There's a lot of work that's been done on, for example, over the last 5 years. Ed Easterling did some research on being long the market, where you get 100% of the upside and the downside, as opposed to where you have only 50% of the upside as well as the downside. And what would benefit you most? Now, if the market's sitting, if you invest 100 Rand and the market drops 40%, then you're down to 60. You need 67% back to get back to break even.
Yeah.
If you're in a 50% up and downside capture, sort of capture environment, then you drop to 80. you will not get the 67, you only get 33, but it takes you to 107 Rand. And if you repeat that enough, that is how compounding works. So a big part of what we focus on is not only saying compounding is the eighth wonder of the world, is understanding what drives compounding. It's variation and it's drawdown. So you need to be very mindful when you structure a portfolio and what you see that's happening in the macro environment around you, that you try and manage drawdown risk over time. Standard deviation for us is not really the risk metric. I don't care about upside deviation. That's good for the portfolio. What breaks compounding is drawdown.
2 minutes, risk and return, and summarise what you've just said in the last 12 minutes or so. Why should the clients go to IP? What are you offering them that they can't get elsewhere?
Okay, clients are 2 levels. First is if you consider the end client, is if the end client has got long-range, long-term sort of objectives, liabilities they need to meet, and they want to get there with the highest probability and the lowest risk. That is a service that that's where we spend our time. We purely focus on structuring portfolios that's risk appropriate, rebalancing them, and then making sure that we understand the risk factors. So for an end client, it's about getting consistency and persistency over time, but we are agnostic. So we're not caught up in being in investment style or active versus passive. To us, these are all instruments that's at our disposal that we can utilize optimally for the client. For the advisor, is we actually free them up to spend more time with their clients, to have, we believe, the most meaningful contribution that the financial advisors can have is helping clients to articulate their needs into objectives and managing expectations. And we want to free them up to spend more time, to spend time on their, what we believe is their core activity.
Well, the core activity, of course, is making people money. And on that note, as we close this now, you must be terribly aware of the pertinence of costs, because that has been a feature for the last few years. People saying, well, this cost, that cost, etc. By the time I look at these costs, I've got to make 5% in my portfolio before I even break even.
Yeah. And that is one of the big questions we always get asked is, okay, so your X amount of basis points that you add, what is the value? If we were only putting together a couple of balanced funds in a specific ratio, then then we don't add value. However, what we find is if we look at client portfolios prior to us restructuring them, after our cost, it's actually 90% of the time it's cheaper and it's not more expensive. But cost in the absence of asking what the value is. So at the cost that they get the value of properly defined portfolios, continuously risk managed portfolios. So the cost and the value thing you need to consider, and we are very comfortable that purely for our tactical asset allocation, we've actually have a record of making up more than the fees that we ask.
Very good. We'll leave it on that positive note. Marius, thank you very much for your time this evening.
Much appreciated.
That's Marius Kilian, who's the CEO of 2